Welcome to the deep dive. For many of you navigating the current economy, the real estate market probably feels like a constant barrage of conflicting headlines.
Oh, absolutely.
We hear about prices hitting record highs one moment, then maybe a predicted crash due to interest rate pressures the next.
Right.
The volatility is just constant, and trying to make a rational, strategic decision based on the news cycle alone feels, well, nearly impossible.
It really is. And volatility forces reaction, not strategy.
Hmm.
When you focus solely on current prices and trends, you're really just looking at the surface of the market.
Yeah, just the waves on top.
Exactly. To truly become a sophisticated investor or buyer, you need to understand the bedrock, the foundational mechanics, the financial models, the historical policies, and the tax code advantages that actually create long-term value.
And that's exactly our mission today. We are skipping the daily ticker tape of median home prices and inventory levels for now. Instead, we are giving you the expert tools to interpret the data for yourself and maintain a clear vision, regardless of whether the market is, peaking or plummeting. We're drilling down into the fundamental mechanics that influence everything from property valuation to investment risk. Okay, let's unpack this. Starting with the hidden history and the policies that physically built the modern American market we invest in today.
That's definitely the right place to begin. Because the physical layout of our neighborhoods, the value assigned to a single-family home versus, say, a multi-unit complex, this wasn't some natural evolution. It was heavily engineered.
Engineered, that's a good word for it.
Yeah. So we'll cover four core areas today. First, the hidden policy and historical forces that shaped our communities and defined what location value even means.
Okay.
Second, the heavy-hitting financial metrics like cap rates and leverage that serious investors use to measure profit and risk.
The real investor toolkit.
Precisely. Third, the massive tax advantages, including things like depreciation and 1031 exchanges, that really separate real estate from almost every other asset class.
Crucial stuff.
And finally, number four, the psychological dynamics, including those sometimes conflicting agent incentives and tenant management strategies.
Right. We all repeat that mantra, location, location, location. But the real question is, why did certain locations become inherently valuable while others were maybe systemically undervalued?
Mm,
The story of American real estate is inseparable from the directional role the federal government played, particularly starting back in the 1930s.
indeed. You look at the Federal Housing Administration, the FHA, and the Homeowners Loan Corporation, HOLC. Now, while they were established to prevent foreclosures during the Depression,
Which sounds like a good goal.
a necessary goal at the time, absolutely. But their underwriting practices, the way they decided which areas were creditworthy, essentially determined where money would flow.
Yeah.
And the practical outcome was this massive push toward the growth of suburbs, overwhelmingly favoring brand new single-family dwellings right at the urban edges.
So these policies didn't just stabilize the market, they actively shaped the physical landscape. They basically standardized the single-family home as the gold standard for collateral.
Absolutely. You nailed it. Some sources note that the structuring of FHA mortgage insurance resulted in what became an unusually radical way of legally guarding the single-family home in the United States.
Wow, radical way of guarding.
Yeah. By guaranteeing loans only on properties that met specific criteria, and those criteria often favored homogeneity, low density, the federal government effectively institutionalized the suburban sprawl we know today.
And this shift in where people live, these settlement patterns, brings us right to zoning. Now, for listeners maybe unfamiliar with the history, zoning sounds pretty benign, right? Just city planning.
Right, just lines on a map.
But historically, its purpose was incredibly explicit and, frankly, financially driven to maintain property values and prevent what they called economic waste.
That's a key distinction. Early zoning advocates were very, very clear about protecting the common man's largest investment, their home, from what they perceived as threats.
Like what kind of threats?
Well, the fear was that property values would suffer from the invasion of their district by flats, apartment houses, and stores. They really believed that mixing residential types or bringing in commercial activity deteriorated the asset's value.
And there's actual quantitative evidence to back up their goals, even if we, question the underlying philosophy today.
Oh, absolutely. Zoning was effective, financially speaking, for those it aimed to protect. In historical examples, like when St. Louis adopted zoning laws, property values in some newly protected exclusive areas reportedly quadrupled.
Quadrupled.
Yeah. You could see a property valued at, say, $18,000 jump to $75,000 just because of the new zoning implementation. This kind of success cemented the political and popular will to use zoning as a primary tool for wealth protection.
And as people moved out of the dense cities, their desire for privacy and these sort of self-contained communities physically changed how streets were even designed.
Yes, exactly. The traditional grid system of cities, which is all about maximizing connectivity.
Easy to get around.
Right.
Right.
That gave way to the low connectivity layout typical of suburbs.
Right.
This desire for the self-contained unit, separating home life from through traffic, led directly to the popularization of the cul-de-sac. It really gained serious traction around 1870.
Huh, that early.
Yeah. And the purpose, as formalized by designers like Raymond Unwin, was explicitly to assure family privacy by discouraging any outside traffic from entering that residential sphere. Keep the outsiders out, basically.
Now, we can't really talk about FHA policy and zoning without confronting the much darker chapter of this history, the institutionalization of racial segregation that really underpinned these definitions of value.
It's absolutely crucial context. You can't understand the landscape without it. The FHA's own underwriting manuals were explicit. The agency was, and this is a quote, extraordinarily concerned with inharmonious racial or nationality groups.
Inharmonious groups?
Yes. They feared that if white and black separation wasn't maintained, an entire area could lose its perceived investment value. Value was literally tied by federal policy to racial exclusion.
And the government didn't just, allow this to happen passively. They actively recommended the tools for separation.
They did. The FHA openly recommended using restrictive covenants. These are clauses written directly into the property deeds themselves.
Wow.
To ensure that properties were only occupied by the same social and racial classes.
Yeah.
This wasn't just local prejudice. This was federal policy underwriting the entire mortgage market.
The scale of that, the institutional mandate, is just shocking. We have that really horrific anecdotal example from Detroit in the 1940s, a developer seeking FHA approval near a black neighborhood.
That case perfectly encapsulates the government's role. So this Detroit builder was denied FHA insurance initially. His remedy: he constructed a half-mile concrete wall, 6 feet high and a foot thick, specifically separating his proposed development from the adjacent African-American neighborhood.
A literal wall.
A literal wall. And only after that physical barrier was built did the FHA approve the loan. It just starkly demonstrated that the government prioritized structural segregation when defining what constituted an investment-grade property.
So that structural reality, the separation, the density limits, the sort of architectural homogeneity that forms the basis of what's considered valuable collateral even today. And speaking briefly of architecture, it's also fascinating how style signals status and therefore value over time.
Absolutely. Styles are like historical markers, aren't they? You have the earlier picturesque periods like Swiss Cottage, Queen Anne, which really prioritize irregularity and a sort of romantic feel.
Right.
Then you see the rise of the palatial palaces like Tudor and Beaux-Arts styles, emphasizing scale and grandeur. Big impressions.
Making a statement.
Exactly. And then you get the indigenous styles, like Craftsman and the Prairie style, championed by figures like Frank Lloyd Wright, which sought to integrate the home more with the natural environment.
And it's a global story, too, right? Even something as common as the bungalow.
Yeah, the bungalow craze.
Yeah.
That has roots stemming from the Hindi word Bengala, meaning of Bengal. It was originally used by British officers in India to describe those simple one-story colonial cottages they built there. So these cultural imports, these historical styles, they all play a part in determining what defines a desirable and therefore valuable asset class today.
Okay, so now that we understand a bit about how the location itself was historically engineered, let's pivot to the cold, hard math of real estate.
Right.
Here's where it gets really interesting. Because the strategic investor stops looking at personal feelings, do I like this house?
Right.
And starts analyzing the deal through sophisticated financial metrics.
Exactly. The serious investor views property fundamentally as a cash flow machine. And the most efficient way to maximize that machine's output is through the first foundational tool: leverage.
Leverage. Using borrowed capital debt to acquire an asset, which then supercharges the return on the cash you personally invested. We used a simple $120,000 example earlier, but let's dive a bit deeper into why this ratio is just so powerful.
Let's run those numbers again. It's worth repeating. You buy that $120,000 house, put 20% down, which is $24,000 of your own cash.
Okay.
Let's say the house appreciates just a modest 5% in 1 year. That's $6,000 in appreciation. Now, that $6,000 gain is realized on the entire $120,000 asset value.
Right, the whole thing went up.
But your cash in the deal is only $24,000. So that means your $6,000 profit yields a 25% return on your invested cash. $6,000 divided by $24,000.
25% from 5% appreciation. That's huge.
It's huge. The goal of the strategic investor isn't just appreciation. It's maximizing the use of OPM, other people's money, to inflate that rate of return considerably. Buy below market, finance even more if possible.
That makes perfect sense on paper, especially when the market is rising like it often has. But if the goal is to finance as much as possible, doesn't that high leverage create significant systemic risk for the investor if the market turns downward?
That is the absolute critical challenge. You've hit the nail on the head.
We saw that in '08, didn't we?
We certainly did. Leverage magnifies returns spectacularly on the upside, but it equally magnifies losses on the downside. If that $120,000 property dropped 5% in value, $6,000 loss, that could wipe out a significant chunk or even all of the investor's $24,000 cash equity, potentially forcing a default if the loan is called or if they need to sell at a loss.
So what do serious investors look at to manage that risk?
They absolutely must calculate their debt service coverage ratio, or DSCR. Can the asset's cash flow consistently cover the high debt load, even if rents dip slightly or vacancies increase? It's a high-wire act, really balancing that potential for maximum return against the very real risk of liquidation.
Okay, so managing leverage risk is key. Now, to compare one potential investment's intrinsic performance against another, investors rely heavily on the capitalization rate, or cap rate. You hear this term thrown around all the time.
It's non-negotiable, a fundamental metric.
How do we ensure the calculation is standardized so we're actually comparing apples to apples?
Good question. The cap rate is key for comparing assets across different markets or even different property types. It's calculated simply as net operating income, NOI, divided by the property price.
Okay, NOI divided by price. But getting NOI right is crucial then.
Absolutely. To ensure standardization, we have to arrive at NOI correctly. You start with gross potential income, GPI, what it could make if fully rented. Then you subtract anticipated vacancies and credit losses to get your effective gross income, EGI. Then you subtract only the operating expenses.
Like property taxes, insurance?
Exactly. Property taxes, insurance, management fees, utilities if the landlord pays them, repairs and maintenance. Things directly related to operating the property.
Wait, I noticed you didn't include the mortgage payment, the debt service, in those operating expenses. Why, when we're analyzing the overall profitability, do we intentionally leave out what's usually the single biggest payment associated with the property?
That's a really important point, and the exclusion of debt service is intentional. It's because the cap rate is designed to assess the intrinsic, sort of fundamental earning power of the asset itself, completely divorced from how the buyer chooses to finance it.
Okay.
Think about it. One investor might buy an apartment complex using all cash. Another might use 80% leverage. Their debt payments will be vastly different. The cap rate allows them to compare the fundamental income-generating capacity of two assets equally before layering in their individual financing strategy.
Got it. So a higher cap rate suggests a better immediate yield or value proposition relative to the price. Is higher always better?
Generally, yes. A higher cap rate indicates a higher immediate yield on the purchase price. And remember that inverse relationship. If the income stream, the NOI, is constant, as the purchase price goes up, the cap rate goes down and vice versa.
Makes sense.
But in practice, higher cap rates often correlate with higher perceived risk. Maybe it's a property in a less stable neighborhood or an older building needing more management attention, or perhaps a less desirable asset class at that moment.
So lower risk, lower cap rate usually.
Often, yes. A prime property in a core, stable downtown area might trade at a very low cap rate, say 4%, because it's seen as a safer, more reliable investment. Whereas an asset in a tertiary, maybe less economically vibrant market, might need to offer an 8% cap rate to attract investors due to the perceived volatility or risk. Investors use this to balance their portfolio's risk profile.
Speaking of risk, high-level investors often apply the logic, or at least the spirit, of the capital asset pricing model, CAPM. It gets pretty complex in the stock market, but how does that core idea that increased systematic risk demands increased expected return translate to real estate?
It translates quite directly, actually. In real estate, systematic risk, often called beta in finance, can translate to things like low liquidity. Real estate is hard to sell quickly. High management intensity. Some properties need constant attention. Or economic volatility tied to a specific asset class, like retail versus multifamily housing right now.
Okay.
The CAPM logic simply demands that a more complicated, highly illiquid asset that requires intensive management, Think of a distressed property bought with a short-term, high-interest bridge loan, must offer a significantly higher expected return to compensate the investor for taking on that increased complexity and danger.
And that expected return is often measured by the internal rate of return, or IRR.
Yes, the IRR is a key metric here. It calculates the actual annualized percentage return on your invested equity over the entire holding period, accounting for the time value of money. And the IRR calculation itself is heavily affected by leverage.
How so?
Well, using extremely high leverage, say, that bridge loan covering 85% of the total cost often leads to a higher projected IRR. Why? Simply because there's less of the investor's own cash tied up in the deal.
Right, the denominator is smaller.
Exactly. The investor's relatively small amount of cash generates a massive percentage return when they exit, assuming the deal works out. But, as we discussed with leverage risk, this is where the investor must perform rigorous risk analysis. Are the higher loan fees, the tighter deadlines, and the increased chance of default really worth that potential boost in the theoretical IRR? It's always a trade-off.
And when those quick deals or specialized projects demand flexibility, traditional bank financing often just doesn't cut it, does it? That's where alternative financing comes in, particularly private loans.
Private loans are absolutely crucial for speed and customization in many deals. They're sourced from non-institutional parties, could be private lenders, specialized funds, or even friends and family.
Right.
Because they bypass the slow bureaucratic layers of traditional banks, they can often be originated much faster, sometimes in days, not weeks or months. That's essential for closing quickly on distressed deals or competitive auctions. And they can be structured in almost any way imaginable, offering flexibility on interest payments, maturity dates, repayment schedules, exit strategies, whatever the lender and borrower agree on.
And then there are even more creative structures that allow an investor to gain control without immediate ownership transfer, like the master lease option. How does that work?
The master lease option is quite ingenious. It's great for investors who want to lock in a purchase price and start controlling the cash flow immediately, but maybe lack the upfront capital or want to defer the tax liability of an outright purchase. So the tenant buyer agrees to rent the entire property, say a small commercial building or an apartment complex, from the owner. They pay all the operating expenses, manage any existing tenants, collect all the income, basically run the property as if they owned it.
But they don't legally own it yet.
Not yet. Crucially, they also secure an option to purchase the property at a predetermined price at some point in the future. By delaying the exercise of that purchase option, they defer the legal change in ownership, and therefore, they defer the immediate triggering of things like excise taxes and transfer fees, which can be substantial.
Yeah.
It's pure operational control and cash flow benefit without holding legal title right away.
Okay, if we agree that leverage is maybe the engine of wealth creation in real estate, then the federal tax code is surely the high-octane fuel for that engine.
That's a great analogy. It really is.
Real estate is unique in providing these incredibly powerful mechanisms that allow investors to earn substantial income, but significantly reduce or at least defer their tax liability. And this all centers on a concept that seems almost paradoxical: depreciation.
Depreciation is, well, you could call it the holy grail of real estate tax strategy, particularly for buy and hold rental properties.
Yeah.
It's often defined as a passive loss or even a phantom deduction.
Phantom deduction. Why phantom?
Because the investor gets to deduct a portion of the building's cost from their taxable income every single year, even though no actual cash is being spent on that deduction. And critically, the property itself is likely appreciating in value in the real world. You're deducting a cost that isn't actually hurting your net worth.
Right. For our listeners who are ready to really incorporate this strategic tool, we need to get a bit technical. How exactly is this deduction calculated? And what's the critical first step in figuring out the depreciable amount?
Okay, the calculation hinges on two main factors. First, the IRS mandates a specific recovery period over which you depreciate the asset. For residential rental properties, that period is currently 27.5 years. For commercial properties, it's 39 years.
27.5 for residential. Got it.
Second, and this is crucial, you can only depreciate the value of the improvements, basically, the building itself and certain land improvements, not the land value. Land doesn't wear out, theoretically.
So you have to separate the land value from the building value.
That's correct. The investor, or usually their accountant, must allocate the total purchase price between the land and the building. There are various ways to do this, often based on the property tax assessment ratio or a formal appraisal. So if you buy a property for $500,000 and it's determined that the land is worth $100,000, your depreciable basis is $400,000, the building's value.
Okay, $400K basis. Then what?
You then divide that $400,000 basis by the recovery period, 27.5 years for residential. That gives you your annual depreciation deduction. So $400,000 divided by 27.5 is about $14,545 per year you can deduct.
And that deduction is where the magic happens on the tax return, often allowing an investor to report a paper loss even if they have positive cash flow coming in each month.
Exactly. Let's just follow the money quickly. You take your total rental income for the year, you subtract all your cash operating expenses, property taxes, insurance repairs, management fees. Then you subtract your mortgage interest payment, not principal. And then you subtract that large non-cash depreciation deduction, $14,545 in our example.
Okay.
Very often, especially in the early years of ownership or with high leverage, this calculation results in a negative number, a paper loss for tax purposes, even if cash flowed into your bank account. This passive loss can then be used to offset other passive income the investor might have, significantly reducing their overall taxable burden.
It's really vital then to contrast this buy and hold strategy using depreciation with the high turnover flip strategy we see on TV, which has a completely different tax consequence.
Oh, absolutely night and day. The distinction is critical for tax planning. Flipping property, buying it, maybe fixing it up quickly, and reselling it for a profit in a short time frame is generally treated by the IRS as an active business or trade.
Like being a dealer.
Exactly. You're considered a dealer in property. That profit generates ordinary income, which is taxed at your regular, usually higher, marginal income tax rates. And critically, properties held for flipping are not eligible for depreciation deductions because they aren't held for long-term investment or income production.
Whereas the buy and hold strategy.
Conversely, the income generated by buying and holding capital assets like rental properties is considered passive income, though there are nuances. These properties are eligible for those valuable depreciation benefits. And when you eventually sell, after holding for more than a year, any profit is typically taxed at the lower long-term capital gains tax rates, not ordinary income rates. Big difference.
Huge difference. Okay, now let's talk about tax deferral. Once an investor has successfully used leverage and depreciation for, say, a decade or two, they often face a situation where they have a mountain of accumulated capital gain tied up in that property. If they just sell it for cash, they get hit with a potentially massive capital gains tax bill.
Right, a painful tax event.
That's where the Section 1031 exchange becomes absolutely critical.
The 1031 exchange, often called a like-kind exchange, is a fundamental strategy in real estate to defer, not eliminate, but defer paying capital gains tax, instead of cashing out and paying a tax when you sell a property that has appreciated significantly.
Which you probably want to do to redeploy the capital.
Exactly. You instead immediately reinvest those proceeds into a new investment property of a like kind. The IRS rules for like kind are actually quite broad for real estate. You can exchange raw land for an apartment building, for instance. This allows the investor to continually roll that equity and all the accumulated untaxed gain forward, compounding their wealth much faster without the drag of taxation along the way.
This strategy sounds amazing, but it requires extreme discipline and adherence to some very strict timelines, correct? What are the key rules every strategic investor absolutely must know about the 1031 clock?
The timing is absolutely unforgiving. There's no wiggle room. From the date you close the sale of your relinquished property to the one you're selling, you have two critical deadlines ticking.
Okay, what are they?
First, you have exactly 45 calendar days, weekends and holidays included, to formally identify, in writing, the potential replacement properties you might acquire. You can identify up to 3 properties, regardless of value, or more under specific valuation rules.
45 days to identify. That's tight.
It is very tight.
Right.
Second, you must actually close on the purchase of one or more of those identified replacement properties within 180 calendar days of the original sale date, or your tax filing deadline for that year, whichever's earlier.
180 days to close.
Right. Miss either of those deadlines, the 45-day identification or the 180-day closing, and the entire exchange fails. The capital gain from your original sale becomes immediately taxable in that year. Discipline is paramount.
And the ultimate payoff, the real long-term strategic benefit for using the 1031 exchange potentially decade after decade, comes at the very end of the investor's life, through a principle called the step-up in basis.
That's the grand finale of the 1031 strategy, really. If an investor holds onto properties that were acquired through a series of 1031 exchanges until they pass away, their heirs typically receive those properties with what's called a stepped-up basis, meaning the cost basis for calculating capital gains tax for the heirs is adjusted or stepped up to the fair market value of the property at the time of the investor's death. So all those deferred capital gains that accumulated over potentially decades through multiple exchanges, poof, they're often wiped out completely for the heirs.
Wow, so tax deferral essentially becomes permanent tax avoidance passed to the next generation.
In many cases, yes, under current law. It's an incredibly powerful wealth transfer tool built into the tax code for real estate.
Okay, one final tax point. Let's briefly address using tax-sheltered retirement accounts, like a self-directed 401k or IRA, to invest directly in real estate. This seems like a potentially perfect marriage. A tax shelter meets tax-advantaged real estate, but there are some critical restrictions people need to be aware of.
Yes, it can be done, but the rules are strict and designed primarily to prevent self-dealing or providing a current benefit to the account owner.
What are the main hurdles?
First, the property usually cannot be mortgaged if bought within a standard IRA or 401k. You typically need to buy it all cash using the funds already in the account. Using debt financing or leverage inside an IRA triggers complex rules we can touch on.
Okay, usually all cash. What else?
Most importantly, the investor, the IRA owner, or any disqualified person, which includes spouses, children, parents, fiduciaries, is strictly prohibited from using or managing the property personally.
So you can't buy a rental house in your IRA and then go fix the leaky faucet yourself.
Absolutely not. That would be considered providing services to your own IRA, a prohibited transaction. You can't live in it, you can't use it as a vacation home, you can't personally manage it or perform maintenance. You generally need to hire third-party property managers and contractors.
That brings up a crucial technical detail for more advanced investors using these self-directed accounts. If they do manage to find a way to use debt, like a special non-recourse loan, to purchase a property inside their IRA, what tax penalties should they be acutely aware of?
They risk triggering something called unrelated business taxable income, or UBAIT. If an IRA uses leveraged funds debt financing to buy a property, the portion of the income generated from that debt finance part of the investment is considered UBI.
And that's bad.
It can be, yes. That income isn't sheltered by the IRA status anymore. It can be taxed at trust tax rates, which can be surprisingly high and kick in at very low income levels. It gets complicated quickly. This potential UBI issue is a major reason why most investors using self-directed IRAs for real estate prefer to purchase assets all cash to maintain the full tax shelter benefit without triggering these complex side rules.
All right, let's shift gears a bit. We've gone deep into the history, the finance, the tax code. Let's move away from the spreadsheets for a moment and look at the human dimension. Because investment decisions are ultimately made by people, right? And they're heavily influenced by the often conflicting incentives of everyone involved, from the real estate agent selling the house to the tenant who's paying the rent.
Absolutely. The human element is huge, and understanding incentives is key. The agent incentive problem is a perfect classic case study in what economists call agency conflict.
Agency conflict.
Yeah. When you hire an agent to act on your behalf in this case, sell your house, their incentives might not perfectly align with yours. Think about it. You hire an agent to sell your $500,000 home, maybe on a typical 3% commission to the selling agent side. That agent stands to make $15,000 if it sells at that price.
Okay.
Now, what if that agent holds out for 2 extra weeks, does more marketing, negotiates harder, and manages to sell the house for $10,000 from $510,000?
Here.
Your gain is $10,000. But the agent's additional commission on that extra $10K is only $300, 3% of 10K.
All right. Only $300 more for potentially a lot more work and waiting.
Exactly. For many agents, that extra $300 is simply not worth the additional time, effort, and delayed paycheck compared to just closing the deal quickly at the slightly lower price.
So the agent's primary incentive often becomes speed and transaction volume. Get the deal done, move on to the next one, while the client's sole incentive is maximizing their final sale price. That creates an inherent misalignment.
Precisely. And there's data to prove this misalignment isn't just theoretical. A well-known study, famously discussed in the book Freakonomics, looked at how real estate agents sell their own homes compared to how they sell their clients' homes.
And what did they find?
They found that when agents sell their own houses, they keep them on the market an average of 10 extra days waiting for that better offer. And crucially, they end up selling their own properties for, on average, over 3% more than similar homes they sell for their clients.
Wow, over 3% more for their own house? That could be $10,000 or $15,000 on a typical home sale.
Exactly. Yeah. That 3% plus difference represents a direct financial loss to the client, driven purely by the agent's slightly different incentive structure. They capture 100% of the upside on their own home sale, not just a small commission percentage.
So the takeaway for a seller is you need to be critically engaged and maybe a little skeptical when your agent immediately pushes you to accept the first strong offer that comes along.
Absolutely. You need to understand their perspective. The agent's job, from their viewpoint, often involves managing the client's expectations downward. They might try to convince you that the quick, strong offer is really generous, maybe the best you'll get, thereby minimizing their own time investment and securing their commission faster. A strategic seller has to factor this incentive structure into their negotiations and decision-making.
Okay, good advice. Now let's turn to the buyer side, thinking about psychology and presentation. We hear a lot about staging a home for sale. Is it just about making it look nice, or is there more to it strategically?
Oh, staging is much more than just decoration. It's a strategic psychological tool. It's about setting the buyer's emotional and financial expectation from the moment they walk in the door.
How so?
Professional stagers often refer to the entry hall or the very first area a buyer sees as the entree, like the appetizer in a meal. It sets the expectation for the main course, which is the rest of the house.
Ah, interesting analogy.
Buyers consciously or subconsciously judge the likely quality, condition, and atmosphere of the entire property based on that immediate first impression. If the entryway feels cluttered, dark, or dated, they start mentally subtracting value and anticipating problems before they even reach the kitchen or main living areas. If it feels bright, clean, and updated, they approach the rest of the viewing with a more positive, higher value expectation.
And appealing to specific demographic groups like Gen X or Millennials, Gen Y, requires tailoring that staging to their current lifestyle demands and preferences, doesn't it?
Very much so. We're definitely seeing a divergence in desires based on age and life stage. For Gen X buyers, for example, having stainless steel appliances in the kitchen is often a baseline expectation, a must-have. But interestingly, formal dining rooms are increasingly viewed as wasted, unused space.
So stage it differently.
Yeah, maybe repurpose it as an office or a den, or at least downplay it. And keeping kitchen counters absolutely minimal and decluttered is key. For Gen X, they value function and clean lines.
Okay, what about Millennials, Gen Y?
For the younger Gen Yers, or millennials, a wine fridge is often seen as a key desirable feature now, signaling a certain lifestyle aspiration. They generally share the Gen X disdain for formal dining areas low priority. Kitchen counters also need to be minimal. Staging should always try to align with the perceived functional aesthetic and lifestyle of the target buyer demographic for that specific property and price point.
All of which brings us back to what might be the ultimate rule for any serious real estate investor. Keep your own emotions entirely out of the investment decision process.
It sounds so obvious, right? But it's probably the hardest rule for many people to follow consistently, especially when dealing with properties that have an element of personal appeal or fun, like short-term vacation rentals or flips in desirable areas.
Like that cool beach house.
Exactly.
Mhm.
If you let your personal preference, oh, I'd love to vacation here, or I really like this trendy neighborhood, or I want that specific ocean view, override the cold, hard data on cash flow, rental demand, operating costs, and realistic resale value.
Your ROI is likely compromised.
Almost certainly. The successful investor must focus solely on the numbers. What generates the highest reliable net income, period. Regardless of whether they personally would want to live there or find the location cool, emotion is the enemy of profit in investing.
Very true. Finally, let's discuss the investor actually managing the asset once they own it, the landlord role. Effective property management, you argue, begins not when the rent is due, but way back when the rental application is first processed.
Absolutely. It all starts with setting clear, objective, and non-negotiable minimum qualification standards before you even start marketing the property. Every single applicant must meet the same established financially based criteria, things like minimum credit score thresholds, verifiable income-to-rent ratios, easy income must be 3x the rent, clean background checks, positive landlord references.
Why is having those written standards so important?
It protects the landlord in two crucial ways. First, and most obviously, it significantly maximizes the likelihood of securing a great tenant, someone who pays rent reliably on time, takes care of the property. That's your primary goal.
Okay, and so I'm away.
Second, and equally important from a legal standpoint, having objective, consistently applied standards provides a clear, documented, non-discriminatory business reason for accepting one applicant and denying another. This is your best defense against potential fair housing complaints or accusations of discrimination. You didn't deny them for a protected reason. You denied them because they didn't meet your pre-established financial criteria that everyone must meet.
That makes sense. And we noted earlier that a common mistake some landlords make, especially novice ones, involves accepting a large amount of prepaid rent from an applicant who otherwise seems risky or doesn't quite meet those standards. Why is this generally a major red flag and bad practice?
Landlords should absolutely not accept several months of prepaid rent from a risky tenant as a substitute for them actually meeting the minimum qualification standards. While it might seem like it offers some added security up front.
Like, at least I got 6 months' rent.
Right. But it only solves the immediate problem. What happens when that prepaid rent runs out in month 7? You are right back to square one, potentially stuck with a problem tenant who you knew was risky from the start, and now initiating an eviction process might be necessary.
And does taking that lump sum complicate eviction?
It certainly can. In many jurisdictions, accepting large amounts of prepaid rent can definitely muddy the waters in an eviction case. Courts might interpret large lump sums differently than standard monthly rent payments under the lease terms, potentially delaying the eviction process or creating legal ambiguities. It's generally much safer and cleaner, if local laws allow, to require a higher, legally permissible security deposit from all tenants rather than accepting large, prepaid rent amounts, especially from unqualified applicants. Stick to your standards. Hashtag outro. So to sort of summarize our deep dive today, we've really executed a full strategic audit of the foundational real estate landscape, haven't we?
I think so, yeah.
We went all the way from those foundational historical policies, the government's significant role in shaping neighborhoods through things like segregation and zoning to define property value itself,
Bedrock.
right through the essential mathematical tools used by serious investors, understanding and using leverage effectively, calculating net operating income accurately, and measuring risk versus reward via cap rates and internal rate of return.
Then we cracked open the tax code.
We did, revealing those incredibly powerful wealth-building mechanisms like the phantom deduction you get via depreciation and the long-term wealth compounding enabled by strategies like the 1031 exchange, deferring those gains potentially for generations.
And finally, the human side, the incentives and psychology.
Exactly. Understanding agent motivations, buyer psychology and staging, and best practices for tenant screening and management. It's a holistic picture.
And the knowledge you, our listener, now possess really transcends the daily noise, the latest headlines about the market. You understand now that real estate success isn't about chasing the latest hot neighborhood tip you heard somewhere. It's about rigorously applying these fundamental principles, the history, the math, the tax rules, the human factors, to the specific data and opportunities in front of you. You now possess, hopefully, the strategic clarity to really define the difference between an asset, something that puts money in your pocket, and a liability, something that drains money out.
That's the core distinction.
It really echoes that core philosophy popularized by Rich Dad, Poor Dad. The rich focus on acquiring income-generating assets. The poor and middle class often acquire liabilities they mistakenly believe are assets. True financial power, the book argues, comes not from defaulting to, I can't afford it, but by exercising your strategic mind and asking that much more powerful question, okay, how can I afford it?
Shifting the mindset.
Exactly, which raises a final, maybe provocative thought for you to mull over after this deep dive. Financial history strongly suggests that over long holding periods, say 25 years or more, common stocks, like a broad market index fund, are very likely to provide higher total returns than safe investments like bonds.
Generally accepted, yes.
Okay, knowing that standard market appreciation in real estate, just the value going up on its own, often trails the returns of other major asset classes like stocks over those really long pure holding periods, we have to ask. If you purchase real estate simply to hold it passively for decades, maybe without aggressive management or significant rent increases, is that underlying market appreciation alone really enough to justify the illiquidity, the hassle, and the capital commitment compared to the potentially higher returns and passive nature of other investments like stocks?
That's the question.
Must successful real estate investing, over the long run, rely heavily, perhaps even entirely, on the active and aggressive application of these hidden mechanics we discussed today? Maximizing leverage, exploiting tax strategies like depreciation and the 1031 exchange, and actively managing the asset to force appreciation and cash flow in order to truly justify the investment decision compared to alternatives. This raises an important question. Something for you to mull over.